All right. It is 0 days to expiration, the podcast, episode 97. And today we are going to talk about volatility because we have volatility supreme. Off the hook volatility! It's unbelievable. It's the continuation of what appears to be a bear market rally. It went up. It looked like it was going to go for the gold, and it entered a massive volume well. Now, volume wells in our parlance, tongue got in the way, is a very low liquidity zone. And when price enters that zone, man, it can run. And it did. It ran, but it appeared to come up against an LVN, or a low value node, which is the extreme low in volume. And for whatever reason, that usually provides some sort of inflection point, maybe resistance, maybe not. It's like a gate. Either the gate is open or it's closed. Well, today it was closed, and it looked like it rejected price and sent it back to its previous place of birth. Another volume node that we call T0. All right, so all of that is kind of technical, and if you join our service, become a trial member, you'll learn all about how to analyze volume profile and get a good idea of how price may behave. But in any event, we don't really know what's going to happen from day to day. As a matter of fact, we have no idea. And the best that we can do is we can put up and analyze market structure, get an idea of where orders may be lying, and we can actually see the orders as well. But using our volumetric methods and volume profile, we have a good idea of where orders are lying and where they're accumulating and where it will provide support and resistance and these inflection points. But we don't know for sure because we cannot tell what the market's going to do. Today, there was virtually nothing really of any strength coming into the market, no energies. And I understand that we have a lot of earnings coming out this morning and this evening, and that may have had something to do with it, but it didn't really. I don't think that it was the cause of pushing the market up 50 points in the course of about 10, 15 minutes. No, that's just not how that works. But anyways, that's because we are in one of those markets where bear market rallies in a bear markets are hugely volatile. We've been maintaining volatility on the VIX in the mid to upper 20s. And every once in a while, the market needs a little reprieve. It goes for it. It goes for this violent move upward, which is usually met by another equally as violent move backwards. And that's exactly what happened today. And look, we may still go up again. I don't know. I really don't know. The question is, how do you play these markets? It's crazy. If you don't know where price is going, you don't know the extent to which it will go, what is its direction and its magnitude. We call that the vector, the market vector. And we try to figure this out every morning, at least come up with some idea. What is the market vector? And then from that, we can look at the market structure and say, okay, it's going to go in this direction more than likely, and it's going to come across this piece of market structure, whether it's a value node or a volume well or an LVN or whatever it happens to be. And then we'll come up with what we think are scenarios that might possibly happen based on our knowledge of how price behaves as it enters this market structure. Now, we don't know. So what we do is we'll create a couple of scenarios. We'll create a bullish and a bearish one, and then we'll favor one over the other. Now, of course, in a market like this, where it's a bear market, although we have been going sideways for the past several weeks, or few weeks, generally we pick the bearish scenario. And because that makes sense, right? You go with the trend. But every once in a while, within the context of this bear market, you have rallies. And bear market rallies are, well, they tend to be violent. They're really strong, or they look unnatural. It's not ordered move up. It's just straight up. It's like a, when you're a kid and you used to have those, well, I don't know. It depends on how old you are and what kind of rockets that you might have had. You might have had air rockets. You could have had rockets that had actual TNT in them or some other kind of propellant, or maybe it was some other non-lethal chemical or something. And you set those things off and it just went pew, right? That's kind of like what the market did today. Got up so high and said that was enough and then just turned around. And, well, it got up and hung around there for a little bit, tried to decide whether or not this was for real, and then moved back down. Now, what caused it? We don't know. And it's pretty much that way every day. We really don't know what causes the market to go up and down for sure. We get hints. We see economic reports, and we can see, cause, effect, that sort of thing. We don't, see, the problem is that when an economic report comes out, and it may report bad or it may report well, in other words, worse than expected or better than expected, that generally puts some level of energy into the market, causing the market to move up or down. But see, that's only half of it. The other part is that we don't really know why the market is reacting to that economic report every time. Sometimes it's obvious. You see the headline number and it's obvious. Great earnings, or not great earnings, but a great job report or a great energy report or a great PMI or, whatever it happens to be. The thing that we don't know is that each one of these reports are multifaceted. You get the headline number, and then you get the other numbers that make up the report, all the other extraneous data. The big boys in the institutions, they're analyzing all this stuff. And they may react to that headline number at first, but then the underlying data may tell them a different story. So that's one bit. Then there are the cases where the market is in what we call opposite world. And it can go into opposite world every time, every once in a while. And that is really based on market expectation of what the Fed might do given this data. And that could be diametrically opposed to what they would normally do. And so we have to look out for things like that. It's basically this random cluster. And over time, we get a better feel for things. We get a better understanding. And there are times when we expect opposite world to occur. We understand one market report from another. Some we know that have more potential energy that they can push into the market. Others have less. When there's a Fed governor or there's a Fed meeting minutes or some sort of Q&A that's coming up, we certainly pay attention to that because anything goes on one of those. And so once we've got this general idea of where the market's going to go, we place our bets. And we place them based on the market structure, the energy coming in, and what is our best estimate of how price may behave as it crosses that structure. That's basically what we do. And, we only have to be about 50% right. Maybe, quite frankly, we can be as low as 40% right and still do very well. But if we're 50, 55% right, we're doing really well based on the type of betting and trades that we do. We put on asymmetric trades where the risk is very, very small and the potential profit is very, very large. So a basic trade that we'll put on is usually 1 part risk to 8, 10, 15 parts reward. Yesterday, I put a trade on that was 1 to 26, 1 part risk to 26 parts reward. Of course, the market went exactly in the opposite direction, so it didn't matter. But the amount that I risked was super tiny, so it really didn't hurt me. So that is the type of betting that we do. And because we're doing premium collection and it's on the last day of expiration, we have some edges that work in our favor. One of those edges is that time is a constant. It is going to have a definitive end, and we know that premium is going to decay down to zero when it gets to expiration. And that means that because we are putting on premium collection strategies, that profit curve, that P&L curve is going to be rising. And if we're anywhere in that range of prices, we can benefit from it. And because we're taking small risks, that benefit actually explodes and multiplies. And so it's not unusual for us to have triple-digit returns. In fact, we average 150, 200% on our winners. And sometimes we can have winners as much as 500, 800, 1,500%. That's why we don't have to win that often. We like to win more because the more we can win and the higher we can get that win rate percentage and get into that range and get closer to the center strikes of our option strategy, the more money that we'll make. Instead of making low triple digits, we can make high triple digits, maybe even 4 digits. That's incredible. So there are things, though, that come along with that and knowing how to manage the profits. So we're in this very unique position, unlike most traders who are constantly managing their risks because their risks are generally much larger than the profit that they're going after. I have no idea why they trade that way, but that's basically the general rule for almost all retail traders. Very few retail traders actually trade with that inversion of risk that I'm talking about. Very few. I mean, almost none. And you wonder why so many people lose. Well, I don't wonder. We know why. But most professional traders, professional investors, entrepreneurs, anybody who is successful knows that what you do is you take small risks for huge outsized reward. That's how you get ahead. It's no different with trading. So that's what we do. But with that, there comes an understanding of how an option is going to react, how it's going to behave in this change in price movement and volatility. So there are a couple of things that we have to keep track of. One of them, obviously, is delta. Now, delta is the value of our options contract, and it's based on the movement of price, sort of like the velocity of price. And as we get higher deltas, we have a higher probability that we're going to profit. As we have lower deltas, there's a lower probability. So we keep track of that. Not so much, but I mean, we do put on directional trades, and we want the direction of price to come within our range of prices that we would be happy for it to settle on and us profit. So delta has sort of a tacit place in our trades. We don't really keep track of it. We just know that we need to get the best delta we can. Obviously, we'd like to get perfect and get right on the center strike. But what we're more interested in is the behavior once we're there, right? What's going to happen with the trade? What happens when volatility is increasing or decreasing? Because that's really what will determine what our real risks are. And like I said before, unlike other traders where they're managing their risk, our risk is already well defined by the initial risk that we take on, and it's super small, and we accept that loss. So we're in the high quality problem of not managing risk, but managing profits. It's a much better place to be. Trust me. And like I said, we only have to be right a little bit more than 40% of the time to be pretty profitable. If we're 50 or 55%, if we're 60%, it's, we're doing great. And so that means that we need to place those trades based on where we think where it's going to go, and we're going to be somewhat in the vicinity, and it's going to work for us. Now, the things that we're really looking out for is, like I said, the change in volatility, actually, or the rate of change in delta, which is called gamma. All right, so that's a real important indicator for us. And what I'm talking about, delta, gamma, vega, these are all the Greeks that are all kind of like the dashboard, sort of the dashboard in your car that's showing you the engine RPMs and how fast you're going and the oil gauge and all that. That's basically what we're looking at. And for us, when we get, say it's early on in the day, like today, and price shoots up like that, and you put a strategy that was way out of the money and price comes up and meets it. You say, cool, but it's still early on in the day and we don't have a lot of premium decay yet. So even though if this were at the end of the day and we might be making thousands of dollars, our profit is minuscule, maybe $100 or $200. That's not necessarily minuscule, but minuscule to what it could be. If the only thing that changed was the time of day and the amount of premium that decayed. So what we have to really decide then is, what do we do? How do we manage that trade? Do we take it all off right then and there? Or do we wait? Right? So when price moves up like that, there are a few things that happen. One thing that happens is, as price is moving up, implied volatility is generally moving down. In other words, volatility is moving down. When volatility moves down, that means that the rate at which premium is increasing inside of your premium collection strategy is actually increasing. And that is because our premium collection strategies are what they call vega negative. And that means that when volatility is moving down, that benefits the strategy. So premium inflates more. Plus, we have time going on our side. So that adds to that as well. However, if volatility were going up, let's say that we were coming at it from the opposite direction and price dropped hard and volatility was rising, that has a tendency to do the exact opposite. Now, we still have time on our side. So time is constantly clicking away, and that premium is decaying based on that time aspect, but it's being held back by that rise in volatility. That rise in volatility is kind of sinking premium at the same time. So these are all things that we have to keep an eye on. This is our dashboard. So that unique position that I was talking about earlier, where you put a strategy that's way high, it's a really bullish strategy. And like today, price shoots up and we go right next to our strategy. And we're not quite inside of the heart of the strategy where you make the most money, but we're just right on the edge. Well, what happens there is that now we're subject to something called gamma risk. Now, gamma risk is the rate of change of delta. Of course, we want delta to get to 1, but now between 1 and 0, that rate that when it's moving starts accelerating. And that's because if you were to look at the profit curve at that particular point in time, and if you're on the edge of it, that profit curve is kind of like, imagine a bell shape, like a normal distribution bell shape. And it's kind of wide on the ends, and then as it comes up to the middle, it's a bulbous thing. But on the edges, it's steep. And that's where we're at. We come right up to the strategy. We don't get into that very center where it's nice and meaty. We're right on the edge with that steep edge. That is what we call gamma risk. That means that the acceleration of delta, or the change in price, and the change in the value of our contract as it relates to the movement of price, is accelerating as it either goes up or down because of that steep profit curve. So that's what gamma risk is. I don't know if you can imagine that. I mean, I could draw that out and you can see it and you go, oh yeah. Basically, you're sitting on top of a bell and then you move a little bit off center and you go to the edge and then it's really slippery and you slide right down the bell. That loss of traction right there, that's your gamma risk. So that's what happens. So then you have to make a decision. Do we take it all off right then and there? I mean, it's only like 10, 11 in the morning and we're already in profit, but there's no guarantee that I'm going to hang out there or move to the center of the bell, right? To move to the center and just hang out there. We don't know that. So you have a decision to make. If you have multiple contracts on, you might want to take a couple off. Take a couple off, maybe guarantee yourself a profit and let the other one ride. That's an option. If price moves into the center of that strategy and you're sitting right on top of the bell, right at the meat, Now your gamma risk is much less because there's sort of a flat area at the top of the bell, and you can go left or right or up and down and not really affect price that much. It's when you start going to an extreme, more to the right or more to the left, where gamma risk starts increasing and your profit starts going down. So those are the type of situations. Those are the type of things that we do to manage our profits, understanding the difference between delta, gamma, and vega, and then how they affect price as they come in and out of our strategy. And of course, there are a lot of other factors that you have to take into consideration, such as what time of day is it? You know, as we get further on in that day, our gamma risk increases even more. And that's because the shape of the bell goes from relatively flat to more and more pointy until it fills up our strategy. Now, the strategy that we use is the butterfly. And if you know the butterfly, basically it looks like a triangle, right, with the point sticking up. And then that P&L line is the thing that will eventually fill up that triangle. So it starts out nice and flat, really wide, lots of range for profiting, but it's not really high, right? It doesn't have a lot of profit. And then as time goes on, it's growing and growing and growing and growing and then filling up that triangle. And as it's doing that, the middle of it is getting skinnier and skinnier. So the gamma risk on either side of it becomes greater and greater. Now, there are other aspects to it too, that once you start getting into this style of trading, you start understanding what's going on. You could be outside of your profit tent, your butterfly, and because of maybe it's early enough in the day, and you'd be surprised how long this will last, that the profit line, the curve that's going to eventually fill up your butterfly, is relatively flat, kind of this big rolling hill that's sitting over your strategy. And you could be sitting outside of the profit tent of the butterfly and still be in tremendous profit. A lot of times, triple-digit profit, 100, 150, 200%. And you have to decide, you know, I've been sitting here for the past 2 or 3 hours. We got over here at 10 o'clock. It's now 11 o'clock, 12 o'clock. We haven't moved much. We took one little jaunt inside the butterfly, and then it came back out. It looks like there's some resistance there for whatever reason. Maybe I should get out, or maybe I should take part of my trade off. You know, ultimately, we'd like to end up every time right in the center of that butterfly, because that's where you can achieve those 4-digit returns. But we know as traders that only happens about 10, 15% of the time. About 40, 45, 50% of the time, our bread and butter trade happens someplace outside of that center, maybe on the edge of the butterfly or just outside of it. And that's where we know we're going to derive a good portion of our income. Now, those center strikes, we call those pins. Those pin trades are what give us the classic long tail profits. So you've probably heard that before. You want that long tail distribution, and you want it in the good side, the side that gives you profit, and that's exactly what we have. We have that nice long tail potential, where that can often make our week, our month, our year, if we just consistently can get in there 1 out of every 10 trades, it's going to have huge impact and influence on our total capital. And that's generally what we do. That's how you manage profits in a volatile market, by understanding delta, which is the velocity of price, gamma, which is the acceleration, the next order derivative above that of price, and vega, the change in volatility. So all of those things come into play. Understanding our general market structure, where we are, what influences price going in and out, where's the best place to place a trade, how to manage those trades once we're in profit, are all what you will learn here at Zero-DTE. Okay, we have some comments here in general stuff. Jim says Google announces a hiring freeze and the market is pulling back. Yep, that makes sense. I was talking about that a little earlier. My delta is beta weighted. I actually talked about this yesterday. I said that some of the big tech companies are going to start talking about hiring freezes, and then the next will be layoffs. That's going to affect our market big time. Right now, I think the government and the Fed, they're pounding, they're thumping their chest. It's such a great labor market. There's no chance of a recession. Of course, they said the same thing back in 2008. But labor is usually the last thing to go when you have runaway inflation and all the turmoil that we have. There's no stopping it. These are the types of things you also need to be tuned in to what's happening in the market so you can anticipate whether or not you're going to have negative or positive vega and how that's going to affect your trade. But just to say, I think that eventually, once Google's and the Apples start freezing and then eventually laying off, we know that Facebook is in the same situation. That's when the Fed is going to reverse what they're doing. They're going to say, increasing interest rates now will do nothing but accelerate this problem. Because if they're increasing interest rates, what they're doing is they're making the cost of money and the cost of doing business more. And the easiest way for a company to relieve themselves of these higher costs is to lay people off, because human resources are by far the biggest expense for the most part in most companies. Maybe not Tesla. I think robots now are their biggest expense. But human labor is the biggest expense, and that's the easiest thing that you can do to bring yourself back to solvency or to acceptable margins. And so it's between a rock and a hard place. The Fed's going to say, hey, runaway inflation, we have to raise interest rates. But the interest rates are causing hardship on companies. They're laying people off. Uh-oh, all these people now are going from okay with savings and everything else and spending money to not. And now the government, they get all upset. They think, oh my God, we got elections coming up in November. We have to do whatever we can to keep these people happy. Let's throw money at them. Of course, if they throw money at them, that money doesn't come without a cost. That money has to be created. And who creates it? The Fed. So they can't raise interest rates and create money at the same time. You see the dilemma here. So that's the snafu that we've gotten ourselves into. Rising interest rates and economic turmoil, otherwise known as stagflation. But from a zero-DTE trader, these are not real big hardships for us. As a matter of fact, they present incredible opportunity. When we have mornings that are filled with volatility, that increase in vega will actually allow us to get into cheaper trades. So we can get into even more asymmetric trades and take less risk for higher potential profit. And then we will wait a little bit during the day for that initial push in vega to subside, and then the whole thing kind of reverses. And if vega then starts declining, then the trade that we get into super cheap now starts becoming valuable to us. And now we're looking at, we might be able to get out of this trade super easy and early with huge profits. Just got to watch that vega and that gamma and that delta. Now, there you go. You just got your first lesson in zero-DTE profit management. Because we manage our profits, we don't manage our risk. I guess another word for managing your risk is managing how much you're going to lose. And then the antithesis of that, managing your profits, is managing how much you're going to gain. All right. That's all I've got to say. Thank you very much for hanging out with me. Peace to you all. And we'll see you next time.